Over the past 2 years, the Magnificent Seven has significantly outperformed the broader S&P 500, rising more than 120% over that period. But can the magnificence of the Mag 7 really last? Our next guest, Global Fund's top holdings include 6 of the 7 magnificent names. John Belton, Gabelli Fund's portfolio manager, joins us now. John, I want to start with sort of what I feel like is one of the hot debates for this year is whether Mag 7 keep outperforming or we get sort of this broadening out of the rally. And as Bank of America put it today, they become the Lag 7, right? And they're not necessarily outperforming the index anymore. Where do you sort of stand on this debate in terms of Mag 7 outperformance and if that can continue?
Thanks, Josh. Good to be with you virtually. I think the Mag 7 has really, really strong fundamentals. I'd start there. And so long as those fundamentals continue, I don't see valuations here looking particularly stretched. So I think we take them case by case, can talk about any of them. But I do think right now these companies are showing really solid top line fundamentals. They're clear AI beneficiaries. They're expanding margins. They've got great capital allocation policies. It's kind of hard to find better positioned companies right now. So that's sort of the default lens I have when I think about this year.
Is that the case for Nvidia too?
I still think Nvidia is incredibly well positioned. I think a lot has been made about this DeepSeek's new models, which were first released a month ago. I still think Nvidia plays really well with DeepSeek. They're still the primary arms dealer to not just the generative AI industry, but to the broader AI and machine learning industry. I think Nvidia, if you look at just on headline valuations, it's one of the cheaper Mag 7 stocks here. So I still feel pretty good about Nvidia.
John, I want to pull up a chart. This is a chart a lot of strategists often show me when they're talking about sort of this broadening out, right? It's the look at the Mag 7 versus sort of the 493 earnings estimates, right? And it's consensus, right, at least from FactSet. We're supposed to converge a little bit this year. And normally someone would say, well, you probably want to buy the green line, right? Earnings are coming up and you're looking at earnings slowing for the Mag 7. I guess why isn't that the case and why isn't that necessarily just kind of the easy read through when you look at earnings estimates?
Well, first, I can't quite make out all the details in your chart, but I think what the chart's telling me is when we look at 2024 as just kind of a historical context, the Mag 7 drove something like 35-40% of the S&P 500's return, if memory serves. Drove more like 65-70% of the index's earnings growth. And on balance, the Mag 7 had positive earnings revisions. The 493 had negative earnings revisions. So I guess just to frame the question, I'd start by saying Mag 7 driving way more of the earnings growth than the stock price performance growth and having positive earnings estimate revisions versus the rest of the market having negative estimate revisions. When I look at the go forward in your chart there, what that tells me is the market's baking in some pretty good acceleration for the 493 and is expecting deceleration for the Mag 7. So I think you could argue that, expectations look pretty achievable for the Mag 7. And obviously it's a market of stocks, not a stock market. Every stock has to be taken case by case, but the market's banking on acceleration among the 493. So we'll see if that happens, but feel good about the Mag 7. They've been over delivering. Don't really see a reason why now they would stop over delivering.
And when it comes to sort of the argument that also fits within that of large caps continuing to outperform, right? Maybe if we stay in sort of a higher rate environment here, people sort of like going with those heavy cash flow companies, great balance sheets. Where do you sit on sort of that level of things? Is that also part of the argument you're making here?
Again, so I personally am more of an individual stock picker, so I don't think about things in such broad strokes. But what I would say is, I think a lot of the largest companies right now have great fundamentals. And even when we look at kind of valuations in historical context, I think take the Mag 7 again. The Mag 7 valuation currently, it's rich versus history. I think it's kind of like a 80th percentile type valuation versus history. But if memory serves, the 493 is actually trading at a richer valuation versus history. So it's not to, pitch Mag 7 and nothing else, but it's just to say, again, I don't see valuation in a vacuum as a reason not to like Mag 7.
John, what do you view then as the biggest risk then to your bull argument when it comes to tech? If we're not worried about valuations, if we're not worried about some of the other factors that have very much been laid out from other strategists on the street, what is that one thing that investors should be keeping in mind?
I'd say probably two things. From a macro standpoint, I do think inflation and reflation, more specifically, is still the greatest risk that the stock market faces as a whole over the near term. I think for tech and for big tech specifically, I think artificial intelligence is something that is very exciting. It still, I think, is in early innings, but there's definitely a lot of expectation built in there. And, I think we are going to have to start seeing some useful end user facing products and applications come to market to make investors comfortable with the amount of investment that's being deployed towards this technology. So I think artificial intelligence would be both a big risk, as we saw this week, but also a big opportunity.
All right, John, great to get some of your time here this morning. Thanks so much.
Thanks for having me.